get to add on your compounded winnings to that. And most importantly, the entire way up, your invalidation is moving. So very quickly, this becomes no risk because the stop loss moves up to here. So in worst case scenario, once you enter your second position, worst case scenario, your first position gets stopped out in profit. Your second trade, again, much the same. Once you get that next break and you enter the next trade, it becomes zero risk, can only get stopped out in profit. And so the point of this is that as you follow the trend will not always make that next final leg and get you that nice exit. It might go up here and then reverse down to stop. And in this instance, one of your trades takes a loss, which is 25%, which would be 0.25R. But your other trades are in healthy profit. And so overall, your trade is a winner. So every time you trade, you will make winners, you will compound those winners and grow into the position. Whereas if you only ever enter with a fixed 1R at the beginning, you can only either win or lose, right? There's no opportunity for getting stopped out in profit. There's no opportunity for compounding. So you stack a 4R on top of a 1.7 on top of a 0.6, whatever it ended up being. And you'll take X number of losers versus X number of winners. In this method, you'll take fewer losers, and when the losers come, they're smaller. They are literally half the size, because if you're going to be wrong, it's going to be at the start. The benefit of pyramiding is you can only be wrong once, and if you are wrong, it's half size. So you would take a 50% hit instead of 100%. And everything after that, if it moves even just one more leg in your favor, you can't lose because your original trade is in profit. That's the purpose of it. And that is also where trailing stop losses come in. Right? So now, talk a little bit about trailing stops as you had seen them there. As we rise up in a market, in this hypothetical uptrend, we break market structure bullishly, and then price continues to go up. So each of these green lines is a BOS, break of structure, denoting an uptrend all the way until the next market structure break, which tells us we're going to shift potentially into a downtrend. So how does a trailing stop work? Well, let's imagine you had one position, which was an entry here with a stop loss below the swing low, and your target, let's just say hypothetically, was all the way up there. All right? So overall, there's your initial trade. In a perfect world, it went all the way to there and you took profit before any breaks of structure. Just showing a hypothetical example. So where do you put your trailing stops? Trailing stop, and this is common, do not fall into the trap of moving it too soon. That's fear-based. So what will happen often with new traders is they'll get this initial pump and they'll move their stop loss up to break even really fast. Because they don't want to take the loss. You do not move your stop loss until your system tells you that it's continuation. So the simplest way is with market structure. So until there is a BOS here, you do not move your stop loss. You do not trail one. Once you see that, you can move your stop loss all the way up to the level. Now your stop is there. Now you can see worst case scenario, you get stopped out in profit. Same thing, as price goes up, creates a high, sets a swing low, breaks structure again, your trailing stop moves up to here. Now this is where trailing stops can come in really handy. It sets another high, another swing low, and then it breaks out again. So by right, up here, you move your trailing stop, you drag it up to this swing level, and then you get stopped out on the way down here. So overall, you catch the meat of the trade, and you also exit at the highest probability time. It's also the simplest way to do it. It removes any discretion from it, and you just have a very simple rule that says, if I am trend trading, I want to exit when the trend has likely finished. Remember, you're not trying to predict. You're trying to make calculated bets. And whenever market structure breaks, the only high probability bet you can make is that there's going to be a trend shift. So that is trailing stops, or at least when to trail your stop. There is a function on exchanges called trailing stop. You know this from the order types lesson. I do not recommend that you use them, because they, for one, they're very inefficient. If you have already used them in the past and you're familiar with them and they work for you, then fine. But personally, especially for new traders, trailing stops, I don't like them, because they make you set a fixed dollar amount or percentage amount for your stop to trail price. I'm sure you can already understand the problems with that. That would mean that as price is going up here, if you had a trailing stop, the trailing stop would be going from the level where it's valid, and if you set the trailing stop, it would be rising up as price rises. But it rises up a fixed amount behind, and it could be there, and then suddenly you get a pullback, you get stopped out here, and price goes all the way up into a further trend, right? So you're going to have to be a little more active. Trailing stops. Don't be lazy. Don't use the exchange-based trailing stop. Set an alert so that when price continues in the direction of your trend and valid structure breaks happen, you can go in and say, okay, I move it up now. I manually bring it up. I take 30 seconds to drag the slider up. I take 30 seconds to delete the price and re-enter the new price. Instead of setting an arbitrary $200 stop loss or 1.5%, because guess what? Those get hunted all the time. Because smart traders, smart money, they know that people use trailing stops, and they know how trailing stops are coded. It's usually a fixed percentage or a fixed dollar amount. So it's easy to estimate after a new high, it's easy to estimate how far to pull back. Right? As price comes up and sets a high, let's say here, it's easy to know that the first target's going to be 1%, because that's where a lot of trailing stops will be. So don't put your stops in obvious positions. Put your stops where you are definitely wrong. And that is below or above key market structure levels. That's trailing stops, and that's trade management as a whole finished as a series of videos. Now let's move on to the next lesson. All right, lesson done. Let me go in and check AMA. If there's anything good here, I will. If there's anything good here, I will add it into the lesson. What do I say to my friend who's buying fucking ADA? Just tell him he's no longer your friend. UK Danny, where is a good place to put a stop loss? Obviously above the last swing high or low, but how far above or below to not get stopped out by some random wick? No, above the high and below the low. That's it. 1 cent above or below. Because, again, if you're trying to not get stopped out by some random wick, then you have not understood anything I said in this lesson, right? There are going to be random wicks. Random is something that happens over a series of 5 trades or 10 trades, right? So you might take 10 trades and get stopped out by a random wick 6 times. That's truly random within the distribution of outcomes. But if you take 100 trades with correct stop loss placement, you will understand that the numbers even out over time, the larger the sample size gets, and those random wicks are not such a factor. I've never met someone who's taken 100 trades per a system that ever complains about random wicks or getting stopped out by, stop hunts or anything like that. Because, and I get this, I've been there, I've been where you are, I completely understand. When you see a price comes down and grabs your stop loss, it's easy to think that you've been hunted or that it was an obvious place or whatever. Trust me that if you stick to a core rule, which is market structure, and you put your stop loss below or above the key structure level, and you do 100 trades, you will not get wicked out 60 times. It'll happen a handful of times because that's just as likely to happen as anything else. In any single trade, any outcome is possible. But good question. Crypto Creator has another good question. I don't quite understand the logic behind risk management differences between day trader and swing or position trader. More accurately, why can swing and position trader risk more size, but scalp or day trader only 1-2% a day as daily loss limit? Wouldn't statistically this be insignificant if your system, as in more trades equals more wins, also, and just growing your account? Or is the logic here that when we lose money, we become apes and start breaking the rules of the system? It's very, 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 very simple. Trade frequency and not blowing up. Your daily loss limit cannot be more than, say, 2 or 3%, because every day you trade. So, if you have a 2% daily loss limit, there is a chance that you could lose 10% in a week. You trade 5 days, you lose every day, right? On an extreme week. But remember, if you trade long enough, those weeks will happen. In that same time, a swing trader might have taken one trade and took a 2% loss. Maybe took one trade and took a 5% loss. Maybe. If it was a high probability trade and it somehow didn't work out, they might have taken that loss, might have taken 5%. But the day trader's taken 10%. And that's with good risk management. And a position trader, over that same week, their trade would still be open. So it's all about frequency. If your trade is expected to play out over 3 months, then you need to risk more because you can only take 4 trades a year in that system, right? A day trader does not need to risk 5, 10, 20% because they take 5 trades in a day sometimes. It's very simple. Day traders and scalpers must have a daily loss limit. Because if you risk 1%, let's just say 1%, which is really conservative compared to what most apes do. As a day trader, if you risk 1% of your portfolio every day, you only have 100 days of runway. 100 days where you can actually trade. That's 1/3 of a year. Right? That's only slightly more than 1/4. 3 months. You have to think about the longevity here. And that's 1%. We know that most people don't do that. Most people have a $1,000 portfolio and they're risking $100 per trade as a scalper. Well, guess what? You're going to be dead in a week. And even if you have a system, even if you have a profitable system, you will know this because a profitable system over hundreds of trades is going to have streaks, like the streak I showed in a previous lesson, where there are 13 losers out of the first 15 trades. If that was a day trading system, that would be an entire week of loss limits hit, right? Let's say 3 trades a day, 5 days in the week, 15 trades, you take 13 L's, you're going to basically hit your loss limit every day. That week, you're going to lose between 5 and 10% of your entire portfolio in 1 week. That's a huge hit, both psychologically and financially, right? If losing 5 to 10% of your net worth in a week doesn't make you think, yeah, I definitely shouldn't risk more than that, then you're going to get wrecked. You just need to visualize where you will be rather than where you are. Because all of what I just said can happen and will happen to an experienced trader. I'm not talking about a newbie ape. But the problem with newbies is when they have small portfolios, and I'm not talking to you specifically, crypto trader, because I don't know anything about you. But a common trap of new traders, which is why I talk about R and I talk about percentage, not dollar terms. The new trader thinks, well, I've got $1,000, so I need to risk more. I need to make more. But they're skipping and shortcutting a process that they're not learning how to trade with correct size, how to correctly grow an account.